few minutes of your time. I know it's the time of the day when you need another coffee. David kicked us off today with this image that resonated with me and probably with all of you, some of you as well, the image of this overarching patriarch and the scions of a wealthy family that are going to inherit the wealth and them having a very different way to think about how they want to invest, what kind of legacy do they want to leave, should they live in the shadow of their parents or their grandparents who started the family business. Right? Yesterday at the Delhi summit, we also talked about, we actually had a panel with 3 of the scions who are going to inherit, and we listened to their views. The kickoff yesterday was Mr. Dalmia, who actually said that if I could invest in something that is socially responsible, I'm willing to tolerate about 100 to 200 basis points of lower returns. So the desire is there to invest in something conscious, socially responsible, and they're willing to take a lower yield. What I'm here to talk about today is number one, as caterers to the family offices or advisors to families, one of your goals should be to advise them on their brand, their reputation, making sure that your values are aligned with the values of the younger generation, the millennials. How do they think? And can you deliver performance without sacrificing, despite the fact that you'll do socially conscious investing? So that's in a nutshell what I want to talk about. I took the liberty of changing the title. Instead of calling it scientific investment, which is what we do, but it sounds very left brain. I wanted to change it to investing with your heart, which is a little more right brain. Let's start with a quick survey of values and the values of people in this room. I'm going to ask you questions simple to more complex or harder, and I want to see a show of hands to see which side of the fence do you sit on. For example, if I were to ask you, why is this? Can you hit next on the slide? How many people in this audience believe that prize money should be equal for men's sports and women's sports? How many? So the ones that are not raising their hands believe that men should be paid more for playing the same sport? USTA was one of the first organizations to mandate equal pay for tennis tournaments. But there are tournaments around today where men get paid more. So we don't have equality. Next question. Do you think or do you believe that companies should be allowed or should be required to offer same-sex benefits, gender-neutral restrooms, similar compensation, equality in workplace? Do you think it's a good idea? Yes, no? There is no judgment. I just want to know which side do you think. Should there be equality, LGBTQ equality in workplace? I'm sorry. I'll move the chairs out. The idea is, should there be equality from an LGBTQ perspective? Should we treat them as equals? Absolutely. I believe that. Now let's come to a little more questions where you can sit on both sides of the fence. Should we legalize recreational marijuana? A lot more hands. Going back further, we talked about, I think there was a question on climate change. There was a question on fossil fuel companies getting disrupted by electric vehicles. Should we be issuing any new licenses for businesses that invest in fracking? There is a tremendous amount of damage that are being caused by companies that are fracking, basically opening up the earth. Should we shut down ExxonMobil, Chevron, the old school fossil fuel companies? And again, even harder, because you can sit on both sides of this, should we allow people to just go to the market and buy assault weapons for hunting? Yes, no? And if you ask the question, I mean, again, there is no right or wrong. You can choose to be on certain side of a question. You have a certain moral compass. You have a certain set of values. A third of America would actually say yes to the last question. And not only that, they'll fight for it because they think that someday the government can turn rogue and they need to protect themselves. And it's a fundamental right. The next set of questions, so this is just asking you about where you sit on the value spectrum, right? The next set of questions is, do you act because of your values? Are your values strong enough that they'll coerce some action? And again, the actions get, could you please click? So here is a question, right? Would you proactively go and invest in a fossil fuel company, knowing that what they may be doing is harmful to the environment, is causing? So you have a pile of cash sitting and you want to invest. Would you or would you not invest? So again, depending on your value system, you can choose. The harder task, thank you. This is harder. You already are invested somewhere. You own a mutual fund. That mutual fund owns 30 companies, and some of them are companies that don't align with your values. Do you actually proactively go out and disinvest from that mutual fund? That's a little harder to do, but again, it depends on how strong your values are, right? Harder still, if there was a portfolio that aligned with your values, but it was subpar market return. So it was giving you could make more money investing in Nifty 50 or the S&P 500, but this aligned with your values. Would you sacrifice money for it? Would you vote with your pocketbook? Would you vote with your wallet? You have to think about it. How much lower returns? How strong are my values? How much am I willing to sacrifice for the good of the climate, good of the earth, my own personal values? I want to feel good about myself, but I don't want to do charity. And the easiest question of all, right? What if you could get that and do better than market? Would you then invest in with your values? That's the easiest one. So you're getting your values and you're getting more than market returns. And that's what I'm here to talk about. There is a lot of investment people do, which is 100% left brain. You look at the numbers, you say which fund, which ETF, which set of stocks are going to give me the best return. I don't care if it's a gun manufacturer or if it's an oil company or something that basically the right brain's not even kicking in. So that's your purely fiscally driven investments. There is a class that is growing. It's called ESG, that catchphrase, environmental, social, and governance. Companies that have the best practices, that are socially responsible, that care for the environment. And there's a new class of investments being branded as ESG funds or ESG ETFs. Further, impact investing is where you strongly believe in a cause. You want to make a difference. You're willing to tolerate a lower return. For the most part, impact investing to date was done by charitable foundations, like the Rockefeller Foundation, right? Or certain family offices, large ones, will set up a branch for philanthropy, and that's what would cater to the impact investing. And you're starting to get more and more into the right brain side of it. So this is where you're investing with your heart. That was the lower axis. What you saw on the last chart was the lower axis, right? So you're going from no involvement of your heart to a little more indexed, to a little more intentional investing in ESG or impact investing. And on the left-hand side, you have your goals. Can I just recover my capital? Can I do a little bit under market performance? Can I be at parity with the market, or can I shoot for better than market? And ideally, you want to be here. You want to be able to make an impact, but you also want to get equal or better than market returns. And if you just look at the numbers on top, the dollar signs on the top, it kind of tells you where the world is today. You have hundreds of trillions of dollars on the left-hand column, purely numbers driven. Just want the returns. I don't care what it's investing in. But the numbers on the right are beginning to grow, and they're beginning to grow at a much faster rate. So for the SRI or ESG investing, just in the US, the newer numbers are $13 trillion. So people are investing in ESG funds at a much more rapid rate. They're now thinking with their heart. Impact investing, lower numbers, but 100% year-on-year growth. So it's about $500 billion, $500 billion now, as of last year's data. So the first conclusion is that money is shifting to the right-hand side. This is how people are beginning to invest. And this is all us in the room, Gen Xers. I'm sure there are a few millennials in the room as well. The next generation thinks a little differently from us. And case in point, how my son thinks about it, there's been more and more surveys done about how millennials think about investing. And as family office providers, you should think about how the next generation will invest. And they will demand. So one of the questions was, would you be investing in companies that cater to your values or align with your values? And in our generation, that answer was about 28%, and it jumps to about 40% when you look at the next generation. They're far more socially conscious. They worry about the environment. They worry about which companies have best practices. And they want to invest in themes, an idea. It's a climate change fund. It's a tobacco-free earth. It's LGBTQ equality. So there's a theme to it. And the millennials want to know what they're investing in. It could be a marijuana fund, like a weed fund. And there are a couple of ETFs already out there in the US market where people are investing in those funds, and those funds are doing very well. So that number for them, thematic investing, is 83%. So we can draw two conclusions just by looking at the data. What does data tell us? Number one, millennial and post-millennial behavior in investing is far more socially conscious. And as investment advisors, they are going to ask you for portfolios and for funds and for investment vehicles that do that. That is a need for the future, so you have to be prepared for it to answer that need. Number two, we saw from the data that investing in these buckets is on the rise. It's small, but it is on the rise. The question then is, must we sacrifice performance to invest in socially responsible vehicles, in ESG, in impact investing? And I'm here to prove that you don't. You don't actually have to sacrifice performance. So I'm going to start with a case study and then show you how we went about creating, in this particular case, an LGBTQ fund, which talks about gender and sex equality in workplace. We started with a hypothesis. A customer came to us and said, I have this thought. Can we prove or disprove it? And the thought is the following. Companies that actually promote equality in the broadest sense of the word, they actually build better employee loyalty. They build a workplace culture that fosters creativity, that fosters, build a better brand for their customers. In the end, they end up outperforming the market. That's a hypothesis at this time. Is it true or not? So we went about with this methodology. We took from a Washington think tank that has been doing a survey for 17 years of best places to work for LGBTQ equality. We took the data, only companies that scored 100% were included. We intersected that set with the Fortune 500. We wanted it to be a large cap and highly liquid asset. And that gave us the investable universe. The next thing we did, and this is what we do, is data science. We applied a lot of investability screening. We looked at factor-based investing like momentum, dividend yield, liquidity, and annual trading volume. And that gave us the base LGBTQ index. To add another layer, we then did a polling of companies on how is their brand visible to the 11.5 million LGBTQ members that are openly there in the US society. There is probably more, but that's the set that is very vocal about their preferences. And we wanted to see how are the brands represented. So, between a Nike and an Adidas and a Reebok, if there's one particular brand, will they come back to the brand? If they find out that it's LGBTQ friendly, will they move more of their money and purchasing? Will they switch brands? So that's the survey. And once you add that, what you get is the final LGBTQ 100 index. So we are in this process right now, but I wanted to share some early results with you. And it was surprising to us as well. The first thing we found Could you click again? We looked at 11-year period because we wanted to catch the 2008 downturn. So beginning of Jan 1, 2008 till, I would say, 2019, so about October of 2019. And you notice that S&P 500, which again is sort of the standard for measuring almost everything in US, it's very broad-based, it doesn't have a lot of volatility, 96% returns on S&P versus 154% return for the portfolio. That's remarkable. Volatility is about the same. It's actually better than S&P. And as a data scientist, so this is great. It's very encouraging. It means that if this product was launched, people will go for it because not only does it take care of investing with your heart, it's also pleasing your left brain. But a question as a data scientist is equality really contributing to it? Or is it just the mathematics that we applied in terms of investability filters? How much is equality contributing to this? So we did 2 more experiments. By the way, this was after 22 iterations. This actually is the 22nd iteration of the product, which is this results I'm presenting. It actually performed in the down markets much better than S&P annually, year on year. So this is reference data, but I showed you the numbers at the bottom row in the previous chart. So the next iteration was, what if we simply ignored that CEI list, the best places to work? We were neutral. We didn't care whether equality was considered or not. And in that case, the same methodology gives us a fund that slightly underperforms the S&P. So you see the orange line, and it says config 32. That was a 32nd iteration. So instead of 96% returns, it's 84%. Volatility is actually high. It's 4% higher. So it's actually a worse product. So perhaps being indifferent to equality is not a good thing. How about we do the anti-equality index, where we basically, instead of saying disinterested in equality, it was the inverse of equality. So we actually excluded those companies that were in the best places to work. And in that case, the performance drops down further. So in that case, the S&P numbers are the same in all 3 charts. You only get 61% return at a 23% volatility. So the conclusion, therefore, is that equality did matter to that index design. That's just one of the case studies. There are some other proof points that we have done relevant to this market. So we designed the India ESG 25, for example. In general, we've done about 35 such themes, broken into 5, 6 categories. And for each of the category, we have done very rigorous testing of data. And in each case, we're trying to find out, are there socially responsible or different themes or portfolios that deliver better than market returns? And again, we're looking at significant investment returns that family offices can use to drive investments. So this is one of the themes. India ESG, I don't know if you can see the graph of Nifty 50. Again, same period. Everything is measured over the same 11-year period. Thank you. But look at this. It's much lower volatility compared to Nifty 50. The results are astonishingly good. Compared to 80% cumulative, it's 449%, right? So if you look at the next portfolio, the consumer index, again, these are top 25 companies that stand to benefit with India's economy. The volatility is much, much lower. The returns still way better than the 80%, 269%. If you look at the next example, is the fast-moving consumer goods. So this stands to gain with the rural economy, the rural development in India. So again, 300%, 16%, 16.5% volatility. The bottom line is that there is a way to think about these portfolios and design them in a way that give you much more differentiated returns. And themes and portfolios are what the next generation is highly likely to invest in. They're not going to ask you for a random collection of stocks. are much less likely to invest in a single stock unless they're passionate about it, because it's very risky to invest in a single stock. Portfolios make a lot more sense. But then how do you smartly design portfolios that meet the needs of your clients? And that's something what we do. So the problem we solve, we're a 12-year-old company, headquartered in Charlotte, North Carolina, with an office in Bangalore, another office in Hong Kong. Our claim to fame has been that we've been doing high-performance data analytics. So we've been analyzing data for the last 12 years. Keep clicking. There are really 3 ways in which, and this is my sales pitch, you can kick exactly. So the example I presented on the LGBTQ, where a customer comes with us and says, I need a woman empowerment index, or I need a climate change index. Could you help design it for us? We will do all of the research. We will go to right sources of data. We'll do a complete turnkey design. The next one is we have about 30 themes. Of course, there are more in the works, where somebody can license a theme, tweak it to their needs, but then launch a portfolio as part of their offering. And the third one is a complete do-it-yourself model, where we let you have the same software we have. So whatever our guys are using, you can access the same software on fastindex.com for an annual subscription. You can go have at it. You can design. You may have an idea. In that case, you keep the IP that you create. You're essentially just using the software. So those are the 3 ways in which you can engage with us. I believe that is roughly all that I had to cover. Again, there is a ton more background what we have done. Essentially, we have created a large data warehouse of every equity traded on any exchange in the world going back to 1984. So it could be an exchange in South America, could be exchange in Cape Town, Japan. All of that data, clean data that we nightly import from FactSet and Thomson Reuters, and we are applying all the corporate actions. Again, a lot of work has gone into building the platform, but it's available to you for a do-it-yourself model. And we are using the same platform to deliver the kinds of portfolios and returns that our clients are asking us. With that, I don't even know if I have any other chart. I'll be happy to. We can skip all this. I think yeah. So that's me. My colleague Himanshu is here. He's based in Mumbai. And we have a booth outside. I think a flyer for the themes is in every bag. So please feel free to look at it, ask us questions, see how we can help. Are there any questions that I can take? Yes.
Thank you. It was very informative. Can you throw some light on, you showed about healthcare. So what kind of products or services are you offering in terms of healthcare data?
So we are working on a project called the Aging of America. I believe the concept will translate to other geographies as well. And what is happening is, and the central hypothesis, everything starts with a hypothesis, right? That we try to prove or disprove and see if the market will support our hypothesis. And the hypothesis is this, that people are living much, much longer because of advances. I think penicillin was the biggest contributor to it, but there are more advances in healthcare. And because they're living much longer, there are companies that are making drugs that are the hospice cares, homes for the elderly. Obviously, they obviously have conditions like they'll fall and they'll break a hip joint, and then you need a hip replacement. So there is a lot of companies that stand to benefit. So at a fundamental level, you start with an idea or a hypothesis, like you just did, right? And then we go out and substantiate it, that if I took a collection of companies in life sciences, hospice cares and hospitals, will that outperform the market as a theme? Right. So I still don't have the numbers, but we suspect that it'll be. My point is we can design an exact same portfolio for the Indian market and figure out which companies would be. So there is I don't know if you have already done the India healthcare one or not, but yeah, that's exactly how we start.
So, but it's related to investing only.
Exactly. It's related to creating an investable universe, an investable portfolio that supports a theme.
Thank you.
Mm-hmm. Very good. I thank you for your time. Really appreciate it.